There was a major change in our asset management organization structure during the reporting period. The asset management company, MCUBS MidCity Incorporated, was integrated into the parent company, Mitsubishi Corporation UBS Realty Incorporated, through an absorption-type merger. The team of the former asset management company, MCUBS MidCity Incorporated, has been reorganized into the office division of MCUBS. We remain committed to thorough management of the MidCity assets. Now, let me go over the financial results for the fiscal period which ended in June 2019. Operating revenues declined by 4.8% period on period, dropping to 10,279 million yen. And net income increased by 8.1% period on period, rising to 4,994 million yen. 474 million yen of net income was internally reserved for reduction entry, and the balance was distributed. As a result, DPU, distribution per unit, was 2,751 yen. The reporting period recognized an additional income of 1.9 billion yen in gain on sales, since the settlement was completed during the period for the subsequent second disposition of Matsushita IMP building. Excluding this one-off property disposition gain, distribution per unit on a normalized basis was 1,935 yen, which is a large increase of 8.5% period on period. On this basis, the actual results exceeded the forecast for net income by 2.0% and for DPU by 2.1%. This is due to the additional contribution of revenue from the M-City Edogawabashi building, which was acquired during this period, and the effects of growth in rental revenue and decrease in operating expenses. The distinctive feature of MidCity's portfolio is its higher area diversification compared to other office j-REITs. Offices in the Osaka area comprise an especially large portion, about 35% of our portfolio, which is the highest ratio among j-REITs. So, we are the company best positioned to benefit from the favorable Osaka office market environment. Against the backdrop of favorable office market condition, management of our portfolio assets is showing solid performance in all areas, including Osaka, Tokyo, and Sendai. The occupancy rate of the portfolio is up 0.9% from the previous period, reaching 99.4%. There were 40 upward rent revision contracts in this period, the highest number on record. On a weighted average basis, the percentage of upward rent revision was 14.5%, which is also most likely a record high since past values have typically been about 10%. Owing to the rent growth and further cap rate compression, the total unrealized gain or loss of the portfolio continues to improve, and as of the end of this period, unrealized gain was 16.4 billion yen. NAV, net asset value per unit, was 93,715 yen as of the end of this period, and the growth rate since the sponsor change is 47.6%. In this period, we acquired one property in March, the M-City Edogawabashi building. The location is a 3-minute walk from Edogawabashi Station on the Tokyo Metro Subway Yurakucho line. The building has high visibility, standing on the corner plot facing Shinmejiro-dori Street. There are many printing and publishing businesses gathered in the surrounding area. This property was acquired using proceeds from the disposition of the Matsushita IMP building and contributed an additional distribution per unit of 27 yen. Our credit rating from JCR was upgraded to AA- in March. At the end of July, 15.2 billion yen of debt was refinanced. With support from our lenders, we were able to refinance the existing loans, achieving an 8.1-year average borrowing period and 0.570% average interest rate. The appraisal value base (LTV) at the end of this period was 39.8%, due to the repayment of short-term loans, which was carried out to replace assets and increase appraisal value. We believe our debt capacity is sufficient and our financial foundation is steadily growing stronger. We received an ESG rating of AA from MSCI. We are the only j-reit to receive a AA rating from this organization. According to recently published material, JPIF, Government Pension Investment Fund, an organization which is actively engaged in ESG investment, is holding MidCity's units on a considerably overweighted basis relative to our market cap. We anticipate further expansion of this type of investor base moving forward. I'd like to talk through the forecast for the current fiscal period ending in December 2019, which is the 27th period, and the next fiscal period ending June 2020, the 28th period. For the 27th period, there will be no further gains on the sale of Matsushita IMP building, which were posted for the previous 2 consecutive periods, so decline in revenue and income is expected. However, excluding the impact of property disposition, we anticipate steady business expansion due to the income contribution of full-period leasing at the M-City Edogawabashi building and the rent revenue growth of other portfolio assets. The forecast for distribution per unit is 1,955 yen, which is up 20 yen from the reporting period's DPU, excluding the gain on sales, 1,935 yen. For the next fiscal period, the 28th, continuing rent revenue growth and utility expense decline is anticipated due to seasonal factors. As a result, the DPU forecast value is 1,980 yen, an increase of 25 yen.